Hello. So in this session, what we're going to do is we're just going to run through a bit of a review of chapter 14, which was the chapter we covered last week. Just want to go through a couple of those concepts from the homework, and then just going to briefly mention some of the key concepts in terms of the final exam that's coming up in our next class. So what do we have here? If you remember, we were looking at calculating the cost of capital. So we were looking at the cost of equity, the cost of debt, the cost of preferred stock, and then we talked about the weighted average cost of capital. Those were the key concepts from chapter 14. So just to briefly mention this, and you can feel free to just kind of allow the video to play out a little bit if you already kind of went through and looked at these solutions. Just want to talk about a couple of these things. So in chapter 14, one of the things we talked about was cost of equity, right? Understanding cost of equity. We said we could use the dividend growth model, or we said we could also use this other formula here if we had some other variables we were looking at, the security market line approach. There was our formula right there, right? Risk-free rate plus beta times that market risk premium. And remember, the market risk premium is calculated by taking the expected return minus that risk-free rate. If they give us the market risk premium in the question, we don't have to calculate this piece. We just take the market risk premium times beta. So what do we have here? Well, in this question, they told us some information. So they told us that the company has a common stock, has a beta of 1.6. So we know the beta, we know the risk-free rate is 4.7%, risk-free rate, and the expected return is 13%. So in this question, have they given me the market risk premium? No, they have not. We need to calculate the market risk premium. How are we going to calculate the market risk premium? It's this piece right here. It is the expected return minus the risk-free rate. Well, they told me the expected return is 13%. So 13% less the 4.7%, that's going to give me that market risk premium piece, this piece here. I'm going to multiply that by beta, add the risk-free rate, and then that's going to give me my cost of equity, which is what they're asking for here, right? So you can see down below here, if I take my risk-free rate, which is 4.7%, plus beta, which is 1.6, times that market risk premium, which is essentially the 13% less the 4.7%, that's going to give me 17.98%. So we're really just using that formula, that security market line formula, also known as the capital asset pricing model. We can't use that dividend growth formula here because we don't have enough information. We don't have information about the dividends, so we know we need to use this formula right here. Let's look at another question. In this question, they're asking me for the cost of preferred stock. So cost of preferred stock was a little bit different. So we had the formula for cost of preferred stock, right? So cost of preferred stock, that one's a pretty quick one to calculate, that formula here. If you remember from class, we looked at this in this slide here. That was D over P0. So which is really, it's really, what is the dividend divided by the price of the stock at time 0. Then that's going to tell me the cost of my preferred stock. So let's just use that formula. In this case, they told me the preferred stock has a $4.25 dividend, just sold for 92 cents per share, or $92 per share. So what is the bank's cost of preferred stock? All we have to do is we have to take that dividend, which is $4.25, divide it by the price of the stock at time 0, which is $92, that's going to give me 4.62%. So you could have got 0.0462. If you multiplied that by 100, you get 4.62%. That would be the cost of preferred stock. So that one's usually pretty quick to do. Okay, this question, they want to know the company's weighted average cost of capital, weighted average cost of capital. So what is the cost of capital made up of? Well, it's made up of a couple of different items there, right? It's made up of the equity component, the preferred stock component, and the debt component. So there's an equity component, a preferred stock component, and a debt component, right? I'm just going to add those all together, and I'm going to get a weighted average cost of capital the company has if I take into account their weightings. So if you looked at the slides that I posted, and there was information on this in the textbook as well, we got into this idea of the weighted average cost of capital, which is, if I find the right slide here that I'm looking for, right here. Weighted average cost of capital. So if there's a tax component, we can factor that in. If there's no tax component, we don't have to worry about the tax piece. So this piece is just missing the preferred shares piece, but it's the same thing, right? So it's essentially the weighting of my equity times the cost of equity, plus the weighting of debt times the cost of debt, plus the weighting of my preferred stock times the cost of my preferred stock. That's essentially the formula that we're going to use there. So let's go ahead and do that. I need to know the weighting of my equity times the cost of my equity. Well, what did they tell me in here? The company has a target capital structure of 70% common stock, 5% preferred stock, and 25% debt. The cost of equity, they've already told me the cost of equity is 11.4%, so I don't have to calculate the cost of equity, right? The cost of equity, that's this piece right here, they've just told me is 11.4%. That's that RE. I just need to times that by whatever the weighting of the equity is. What is the weighting of my portfolio of debt? So they've told me of capital structure. They've told me 70% is common stock. So common stock, that's equity for the company, right? So 70% times that 11.4%, which you can see down here in the equation, right? The solution, 70%, the weighting of equity times the cost of equity, 0.7 times 0.114. Okay, so this piece here, this 0.7 times 0.114, that's the equity piece. Let's do the preferred stock piece. Well, the weighting of my preferred stock is 5%. The cost of my preferred stock is 5%. So I'm just going to multiply those by each other, right? Weighting of preferred stock times cost of preferred stock. Okay, so that's the preferred stock piece. Now we just need the debt piece. 25% is the weighting of debt. The cost of debt is 7.4. So 0.25 times 0.074. So we've got the equity component right here, plus the preferred stock component, plus the debt component, and then times 1 minus the tax rate. They told me the tax rate is 35%. So times 1 minus the tax rate, that's going to account for the tax component. That's going to give me a weighted average cost of capital of 9.43%. So for weighted average cost of capital, that's really good, right? If we didn't have these elements here, the cost of equity, the cost of preferred stock, the cost of debt, we might have to calculate those using the methods we just looked at a few minutes ago in class. And then we would just have to multiply them by their weightings, right? So as long as we have the weightings, we're able to do that and calculate the weighted average cost of capital. So all these formulas are going to be given to you on the final exam. Okay, so that was the formula we used right here. Okay. And then there's the 1 minus the tax rate. This formula is just missing, essentially. If I were to add it in, it could be plus the weight of preferred stock times the return on preferred stock, right? So this is essentially what that formula looked like that we just calculated there. Okay, it's asking me down below here, what is the after-tax cost of debt? Well, what is the cost of debt right now? They tell me the company's cost of debt is 7.4%. So if I want the after-tax, it's just 7.4 times 1 minus the tax rate. So 7.4% times 1 minus 35%. So 0.074 times 1 minus 0.35. That gives me 4.81%, 0.0481. If I multiply that by 100, 4.81% is the after-tax cost of debt. Okay, let's look at another question. Let's look at a question where we're calculating the company's cost of equity. Calculate the company's cost of equity using both the dividend growth model and the security market line method. We did this in class. In class, when we did it, we got the same answer. In this example, the answer is different depending on the model that you use. And we talked about some pros and cons of using each model. So it's good to know the advantages and disadvantages of each model if we had to pick one, right? So you can review that slide. But we said they give us enough information to calculate it here using both ways, right? There's enough information to calculate it here using both ways. Let's look at the dividend growth model way first. So dividend growth model. We go back up here for a second. There it is. D1 over P0 plus G. D1, dividend at year 1 divided by the price at year 0 plus the growth rate. But remember, D1, how do we get D1 if we have D0? We looked through an example of this in class, actually. So if you go back to the slide we looked at in class, in this example, they told us what our last dividend was. It was $2. So that's D0. They didn't tell us D1. I have to take 2 times 1 plus the growth rate. And that's going to tell me what D1 is. If I take the last dividend and I multiply it by 1 plus the growth, 1 times the plus the growth rate, which is 6%. So 2 times 1.06, that tells me what the dividend next year, what D1 is going to be. So if I take a look at this example here, that's what's happening, right? They're telling me the company just paid a dividend of $2.16. So that's the dividend at time 0, but I need the dividend at year 1. So I'm going to take that 216 and I'm going to times it by 1 plus the growth rate. Dividends are expected to grow at 4%. So 2.16 times 1.04, that's going to tell me what D1 is. I'm going to divide it by the recent stock price, the P0, which is 72, and then add the growth rate. I'm literally just plugging things into that formula. The formula is D1 divided by P0 plus G, which is the growth rate. I'm going to get 7.12%. So if I'm asked to calculate the cost of equity using the dividend growth model, I'm going to want to show my work using that formula, and I would come up with 7.12%. If I was asked to calculate that same cost of equity using that other method, the SML security market line method, also known as the capital asset pricing method, I'm just going to use the formula we used a few minutes ago, right? Which was the risk-free rate plus beta times that market risk premium, which is the return on the market minus the risk-free rate. So they gave us enough information to do that here, right? So if they tell me in the question, treasury bills are yielding 3.2%, that means that's the risk-free rate. Because treasury bills are those really low risk stocks. And if I understand the yield on that really low risk investment, that's essentially telling me what my risk-free rate is, 3.2%. So that's RF. The question is either going to tell you the risk-free rate is 3.2% or treasury bills are yielding or bringing back 3.2% return. That's the risk-free rate. 0.032 plus beta. So in this question, they tell me beta is 1.10 times the return minus the growth rate. Or I should say the return minus the risk-free rate. So the return, what did they tell me the return is? Well, they told me the return is 10%. They have an expected return on the market of 10%, less that rate that we just talked about, the risk-free rate, 0.032. That's going to give me 0.10680. If I multiply that by 100, it's 10.68%. So we have a slight difference, right? 10.68% versus 7.12%. Depending on which model we use, we're actually getting a different cost of equity that we use in our calculation of weighted average cost of capital for the company. Like we said, the dividend growth model method, that's the one that's used a little bit more in practice, especially when that information is available. If we know the last dividend and we can estimate what the dividend growth rate is based on past dividends, it's one that might be more readily available to users. But if we make a mistake on the growth rate, it really throws things off significantly. So it's very sensitive to making sure we have the right growth rate. The security market line method might be a little bit more accurate because we don't have to factor in the growth rate, but we do need information. Like we need to understand the risk-free rate and we need to understand what the expected return is as well as the beta, right? So some information we'd need that might not be as readily available to investors, but they might be able to do some research to get a hold of that information. Okay, so that one's cost of equity. We already looked at an example of that. Cost of debt. Cost of debt, we calculated in class using our calculator. So if you enter in the information into our calculator, we're actually able to calculate the cost of debt. So if we wanted to use our calculator to do this question, I was just having a look at this. We could take a look. We could use we could basically type the variables into our calculator, right? And then what we could do is we could multiply the answer that we get, so that 5.226%. So remember what we're going to do when we're calculating cost of debt. What we're going to do is we're basically calculating the yield to maturity for this investment. So I need to calculate the interest rate or compute the interest rate. If you remember, we did this in class using the financial calculator. So in this question, the firm has a debt issue with 23 years to maturity. So 23 years, semi-annual payments. So if they're making semi-annual payments and there's 23 years, well, N would be 46. N would be 46, right? 23 years times 2 payments a year. The issue makes semi-annual payments embedded cost of 5% annually. Assume the par value of the bond is 1,000. So par value of the bond is 1,000, and so that's the future value of the bond. What is the present value of the bond? I'm just trying to see if I have my financial calculator here, which I don't at the moment. I do. So just to practice, I'm actually going to practice this with my financial calculator right now. So we have 97%. So our present value is 97% of the 1,000, right? So our present value is $970. Our future value is 1,000. We've got N 46. What's my payment going to be here? So we have essentially $1,000 bond times 5%. So I have a $50 annual payment, right? But I need to divide that by 2 because they're semi-annual. So my payment is 25. So 25 is my payment. 46 is my N. Future value is 1,000. Present value I'm going to put as a negative because I wanted negative present value and a positive future value. So my negative is, or my present value is going to be 970 negative present value. I'm going to compute my interest. So I computed my interest. So I hit compute interest. And when you hit compute interest, that IY button, you get 2.613. But because we need to understand the yield to maturity, basically what the rate is for a whole year, I'm going to multiply that. We did this exactly the same question in class with these are different numbers. I'm going to multiply that by 2 and I get 5.22, basically 5.226%. So I just did that in my calculator. If you use those variables, 46 is N. Okay, 46 is N. You're going to have present value is going to be negative 970 because it's 97% of the 1,000. Future value is the 1,000 because when they buy the bond, basically they're paying $970 for this bond and they're going to sell it back for 1,000 in the future. So the present value is negative 970 in your calculator. The present value, the future value is 1,000. We have 46 is the N, and I need the payment, right? The annual payment, well, that's 5% coupon times 1,000, that's $50, divided by 2 because they're semi-annual, so a $25 payment. Then I'm going to hit compute IY. That's going to give me 2.613% as the interest rate, and I'm going to multiply it by 2 to get the annual interest rate, which is 5.226%. So that's the company's pre-tax cost of debt. If I multiply that by 1 minus the tax rate, so by 1 minus 0.35, if we assume the tax rate is 35% here in the question, the after-tax cost of debt is going to be 3.397%. Okay. So hopefully that helps you out. Okay, just give me 2 seconds here. I just want to have a look at one thing just before we move on. If you just give me 1 second here, I'm going to go ahead and do that. There was one other question I wanted to go through here, and I just want to double check something. Okay, this is the one I actually wanted to go through, which is number 7 here. So you are given the following information from McGrath Power. Assume the company's tax rate is 35%. So we see some information about their debt. We see some information about common stock, preferred stock, and what's going on in the market. So debt, $10,000, 6.54% coupon bonds, 1,000 par value, 25 years to maturity, selling for 108% of par. So these are selling for a premium. The bonds make semi-annual payments. So that's the debt component. The common stock, there's 495,000 shares selling for $63 per share. Beta is 1.15. Preferred stock, 30. So this is, I'm going to use this piece for the cost of debt, this piece for the cost of equity, which is the common stock that's been bought into the company. Preferred stock, this is where I'm just going to find the cost of preferred stock separately. 35,000 shares, 3.5% preferred stock, currently selling for $72. And then they tell me the market has a 7% market risk premium and a 3.2% risk-free rate. Okay, so they've told me the market risk premium, so I don't need to go in and calculate the expected return less that risk-free rate, right? They've already told me that the risk premium is 7%. So what I can do is I can find the market value of each type of the financing first to understand what the current market value is, because that's going to help me determine what my weighting is, right? So for each one of these items, since they told me enough information here, I'm going to just find out what the total value of the debt, the common stock and preferred stock is that I have. That's going to help me figure out what my weighting is, right? If I'm trying to find the weighted average cost of capital. So for the debt, I know I have 10,000 bonds and their $1,000 par value. So 10,000 bonds times $1,000 of par value is essentially what those bonds are worth, but they're selling for 108%. So I have to multiply that by 1.08 to figure out what that actual market value is, right? So 10,000 times 1,000, that's going to give me $10 million worth of bonds, but they're selling for 108% of that. So times 1.08, that's going to give me $10,800,000. That's the market value of all the debt that I have. How about the market value of the equity? Well, the common stock, 495,000 shares selling for $63 per share. That's what they're worth right now in the market. 495,000 times 63, $31,185,000 worth of equity is the market value of my equity. And the market value of my preferred shares, 35,000 shares times $72 a share, $2,520,000. So if I add those all together, 10,800,000 plus the 31 million plus the 2 million, that tells me the value of all of my debt and equity. We can denote that as V. That's the market value of the actual firm itself, right? The value of all the debt and the equity. If I add those all together, that basically gives me my denominator essentially, right? $44,505,000. 44,505,000, that's the total value. And I could find the weighting now, right? What would be the weighting of my debt? 10,800,000 divided by the 44,505,000. That's going to be how much debt I have. The weighting of my equity I can find as a percentage of the total, and the weighting of my preferred stock I can find as a percentage of the total. Okay. Okay, so now what I can do is I want to find the cost of equity, the cost of debt, and the cost of my preferred shares, and multiply them by the weightings and add them all together, right? Because if you remember, if I just go back to this slide, this is a good slide from earlier where we went through the weighted average cost of capital, this formula right here. And there was an example as well in the slides. Where is it? It is right here. Okay. Weighted average cost of capital, right? Weighting of equity times the cost of equity plus weighting of debt times the cost of debt plus weighting of preferred shares times the cost of preferred shares times 1 minus the tax rate. And you can see on this slide too, kind of a little bit about what we're talking about here, right? E is equity, D is debt. The value of the actual firm itself is the debt plus equity plus those preferred shares, which are really part of equity, right? So there's some of the variables there. Okay, so let's get the cost of equity, cost of debt, and cost of preferred shares. Let's start with the cost of equity. Okay, the cost of equity, which model am I going to use here to calculate the cost of equity? Well, they don't tell, if I just look at the equity, right? This is just the common stock. They don't tell me anything about dividends, so I can't use the dividend growth model. But they do tell me the price, they tell me the beta, and I know the market risk premium and the risk-free rate. So I know I'm going to have to use that security market line capital asset pricing model approach. And what was the formula again? Well, the formula was take the risk-free rate plus the beta times the market risk premium. The risk-free rate is 3.2%, so 0.032, plus the beta is 1.15, times that risk-free rate of 7%, which is right there. Right, like I said, I don't have to do that extra step here and do the expected return minus the risk-free rate, because they've already told me the market risk premium, which is that 7%. They've already calculated that for us. So there's the formula there for the cost of equity, RE. It's 11.25%. What about, so maybe let's just go with this. Like this. So I calculated my cost of equity, RE, right? Go like this. Cost of equity was, I think we said 11.25%. Smaller. Let's do 11.25 as a percent. See if you can see this. Okay, so I have my cost of equity is 11.25%. So that's my percent. And then I'm going to need my weightings, right? My weights. Okay, well, what's my weight of equity? Well, we said it's going to be the equity piece, which was this piece right here, MVE, market value of my equity, 31,185,000 divided by the 44,505,000, right? That's the weight. That's how much debt equity I have as a percentage. So it's going to be the 31,185,000 divided by the total, which was the total value of the firm, 44,505, and 70.07%. That's going to be my weighting. Okay. What about my cost of debt? My cost of debt. Okay. So I'm going to do that basically the way we did it before, right? Let's find the weighting first. The weight of the debt is going to be this number here, right? The value of the debt, the market value, 10,800,000, again, divided by that denominator of the total value of the 44 million. So my weighting of debt is going to be the 10,800,000 divided by the 44,505,000. Weighting of debt is 24.27. And then I'm going to have eventually my cost of my preferred shares. So that's going to be the 2,520,000 divided by, again, the 44,505. 5.6%. That works out to 100% total, right? So now I have the weighting of each one of those components. I need the cost of each one of those components, right? So debt. I'm going to pull up my financial calculator to calculate the cost of debt. So what do they tell me in this question? Let's look at the debt. 10,000, 6.4% coupon bonds outstanding, 1 million par value, 25 years. Okay. So let's go ahead and do this. What is my N? Semi-annual, right? Remember to look if it's annual or semi-annual. 25 years, semi-annual payments. So 25 times 2, because there's 2 payments a year. So N is 50. Okay, so we know 50 is N. Now, what is my payment? Well, the payment on these bonds is 6.4%, essentially is the coupon, the interest. 6.4%, and the value, I'm going to multiply that by the par value. So 1,000 times 0.064 is $64. However, remember, these are semi-annual payments, so it's 64 a year. I need to divide that by 2. So my payment is $32. Okay, so let's go 32, type into your calculator, click payment. N we said was 50, so 50, then click N in your calculator. So it should show you N equals 50. Now, what's the present value? Okay, the present value is a little different here. The present value of this bond, because it's selling at a premium, is going to be the par value. Remember the last question? We had to take 97% of that to get the present value. In this case, it's selling for a premium, so we need 108% of that. So 1.08 times 1,000 is 1,080. That's really what the present value is. So 1,080, I'm going to show that as a negative in my calculator, and then hit PV. So it should show PV equals negative 1,080. And then future value is going to be, we're going to buy this bond back or sell this bond back for $1,000 in the future. So future value, I'm going to type 1,000 and then hit FV. So my calculator shows FV equals 1,000. Now I'm going to hit compute interest, the IY. I get 2.89, 2.895, which is the answer that's showing down below here. Remember, we have to multiply that by 2 to get that year yield to maturity for a whole year, because this is just the semi-annual rate. So if I multiply that by 2, I get 5.79%. So 5.79%, that's your cost of debt. 5.79%. Excellent. Now I need my cost of preferred shares. Cost of preferred shares. Cost of preferred stock. Well, remember the formula for the cost of preferred stock? We just need 2 things. I need to know essentially the I need to know the price, and the dividend, right? Okay. So what's the price? Remember, it's the dividend divided by the price. The dividend divided by the price. That's the exact formula we looked at earlier to calculate the cost of preferred stock. Okay, well, we know the price is 72. What's the dividend? 3.5%. Okay. So what you can do is you can actually just take the 3.5 there. This, I don't really love how this question's worded because they didn't really tell me. I mean, we know we have 35,000 shares, 3.5% preferred stock. But they didn't tell me essentially exactly what that 3.5% means, like what that dividend means. I would have just said a $3.50 dividend. Okay, so let's just assume this said $3.50 dividend. So I'm going to take $3 and 3.5. If it just told you the percent, you can just take that percentage as 3.50. But I would have told you that's a $3.50 dividend. Okay, so 3.5 divided by $72. That's going to give me my cost of preferred stock, which is 4.861. 4.861. There we go. 4.86. So now we have our weights and we have our cost for each one of those elements, right? Now, usually for debt, we would do the after-tax cost of debt if they give us enough information to do that, because there's a cost to, there's a tax impact to the debt. So did they tell me a tax rate? Yes, they did. They told me the tax rate is 35%. So I can get the after-tax cost of debt. So if they give me the tax rate, what I would do is for the debt piece, I would just take whatever I calculated for my debt times 1 minus the tax rate. Times 1 minus the tax rate. 1 minus 0.35. That brings me down to 3.76%. So 3.76% is my after-tax cost of debt. If they didn't actually give me that information, then I wouldn't do that piece. But you can see they gave us that information. So we go from 5.79 times 1 minus the tax rate, 3.764. Okay, so now that we have that information, all I need to do to get my weighted average cost of capital is I just take my cost times the weight for each one, right? Cost times the weight for each one. Cost times the weight for debt, and then same thing for my preferred stock. All I have to do is add those together, right? This is really just taking care of that formula that I had shown you on the slides earlier. There's my weighted average cost of capital, 9.07%. Okay, so that's how we got to this answer here of 9.07%. Is we found out the cost of each one of those individual items, multiplied it by the weight, and we get, that's our total answer there, 9.07%. Okay, so I wanted to go through a comprehensive example of that because I didn't go through that in class, but I wanted you to see that. We went through all the elements in class. It's just you need to do the weightings, add them together. So you saw that there was an example in the slides. You hopefully went through a couple of those this week, and then you can practice additional ones in the textbook if you want to practice that more. At the end of the textbook, there's additional questions as well in the additional resources in Wiley Plus. There's a couple of solutions videos and things like that that you can have a look at. All right, so that's going to kind of go through the key items from chapter 14 that we looked at. Now, what I want to do is I'm just going to open up for a second here. I'm going to open up on Moodle the syllabus just to take a look at that for a second. And then just talk a little bit about the quiz, right? The final quiz. So first of all, the individual assignment is due. Hopefully you've seen the emails and have all the information about that's required. So please make sure you upload that by the deadline. And then like I said, for that one, you want to make sure you upload an Excel file and a Microsoft Word file. The Excel file will show the calculations for each item, and then the Word file will be your write-up for each item, your discussion. Now, with that said, I just want to open up the syllabus and take a look with a couple of items regarding the final exam and just help you focus your studying a little bit. Okay, so let's get the syllabus pulled up. So like I said, the final exam is a cumulative exam. It's worth 25%. So right there, 25%. So right now, you've had your midterm exam grades posted. You've had weekly assignments, right? There's also going to be some sorry, for your Wiley Plus. So you'll see some percentages there as well posted. And then I should say the last piece is the final exam, right? 25%. So if we want to determine where we should focus for this final exam, let me scroll up here. So you had your midterm August 15th, right? So what did you do up until that midterm? Well, it was the information covered up to week 5. So up to week 5, we really mostly went through up to the end of bonds, right? In that chapter. So everything we've done after that is really going to be a little bit more of the focus. So focusing on elements after the midterm, right? Which is really where we got into chapter 8. Chapter 8 was where we started getting into that dividend growth model. So I would definitely study how to do the dividend growth model, calculate the price. We're calculating the price of stocks and shares based on the dividends that are being paid out. So we looked at a couple different ways to do that. We looked at situations where we had constant growth, where we may have had growth that was not constant or no growth. So we looked at that a little bit of the difference between common and preferred stock. Those were kind of the main items in chapter 8 doing those types of calculations. Then we moved into the chapter 9 and 10 piece. The chapter 9 and 10 piece, you want to make sure that you can calculate NPV. So of course, being able to calculate net present value. So being able to do that using your calculator. We went through the calculator technique. You won't have Excel, right? So you want to make sure you can calculate NPV. We went through calculating IRR. And then we also went through calculating, payback period. So we talked a little bit about payback period and profitability index. So those were kind of the main things we looked at. So if you go through those slides and from that module that we did that week, it was really about being able to calculate NPV. I'm actually going to go in and just pull up the slides starting at chapter 8, just to direct your attention a little bit. So here was our chapter 8 PowerPoint. This was really about stock valuation. Like I said, we really got into being able to calculate the return. So we started to think about calculating return. We started to think about calculating the present value of these stocks, right? So there was a couple of calculations on present value, and then we really got into that dividend growth model. So we talked about dividend growth where there's zero growth. We talked about where there's constant dividend growth, right? So this was really that formula that we just looked at a second ago here, right? So this formula will be given to you on the exam. So these are good slides to go back through calculating constant dividend growth. Okay. That was the main piece, understanding the differences between common shares and preferred shares. We did a little bit of that as well. Okay, I want to pull up chapter 9 for a second here. Chapter 9 and 10, mostly chapter 9. So when you're studying, you can mostly look at the concepts from chapter 9, the stuff we talked about in the slides here in this capital budgeting piece. So we talked about the time value of money. We talked about some capital budgeting techniques, payback period, NPV, IRR, profitability index. We went through how do we actually calculate it. We did not use these slides, but I did a whole video. So if you rewatch the video from that video that week, we really went through how do we calculate some of these items, right, using our calculator. So we went through the net present value technique using our calculator, entering in those different cash flows for each year. So make sure you're able to do that, right? You're able to go in and enter the different cash flows into your calculator. So I went through a good video. You can rewatch that video that we did for our Sunday online guided learning class. And we went through and we actually did a calculation here, right, to decide whether we accept or reject the project. So that would be a good one to look at again. We also looked at the payback rule again, understanding how to accept or reject an item based on the payback rule. We also went through this average accounting return. We did a little calculation and calculated the average accounting return. So those were the main elements. We also talked about internal rate of return and calculating IRR. So we said we could do that in our calculator as well. I showed an example of calculating IRR on the calculator. And then profitability index. Okay, so chapter 9 has a decent amount. I would rewatch that video if I were you when you're studying. Then it was basically what we did in the last 2 weeks of the course. So chapter 12 and 13. If you scroll down here. This was where we went into understanding a little bit about efficient markets, talking about expected return and risk, talking about portfolio management. So this was the stuff in class last week when we went through, we calculated the expected return of individual stocks, the expected return of a portfolio, and then we looked at really the variability, right? So we talked about volatility. So we talked about calculating variance and standard deviation. This is stuff I asked you to do. You'll have been doing this on the individual assignment as well. So that's good studying, but there's a good video on that as well from that Sunday session as well. And if you look in chapter 12 and 13, chapter 12 was really what we talked about mostly in class. This was more theoretical, chapter 12 in nature. So we talked a little bit about some of the last bit of chapter 11. You did this on your individual assignment, base case, worst case, best case, looking at NPV. And then in chapter 12, we really started talking about efficient markets, what efficient markets look like. This was mostly theory that we talked about. We talked about what standard deviation is, what variance is, right? We looked at how you can look at the volatility of a stock. And then in chapter 13 in the video, I went through examples of how to calculate variance and standard deviation. So that would be a good video to watch again. Then chapter 14, the last chapter, that's what we just looked at today in class, or I should say we looked at last week in class and we looked at in today's video. We just went through some examples of that, right? Calculating cost of debt, cost of equity, cost of preferred shares, and weighted average cost of capital. So that's going to be the focus of the exam, right? Much more focus on the later pieces of the course. A couple small things from earlier in the course. There won't really be anything in chapter 1. Chapter 1 was just kind of understanding what finance is and the goals of financial management. Maybe one or two small multiple choice questions on that, but there were no calculations there. Chapter 2, I asked you to review financial statements, right? So that we could review how to prepare an income statement, understanding the balance sheet, looking at the cash flow. I'm not going to ask you to prepare any of those statements on the final, so you don't have to go through and prepare those statements again, right? That was just a refresher. Same with statement of cash flows. I'm not going to ask you to prepare that. We got into calculating ratios and ratio analysis. I'm not going to ask you to go calculate all those ratios again in this final exam, so you don't have to focus too much there. There may be something from this chapter, from chapter 5 and 6, when we got into time value of money and using the financial calculator. So that was where we calculated present value, future value. We said if your uncle leaves you an inheritance, would it be what do we think that's going to be worth in the future? If you're planning for your child's university education, how much should you start investing today if you want to have X amount of dollars in the future? So that would be a good one to have another look through and make sure you can do some of those present value and future value calculations. Could see something come up on that again. We went into bonds in chapter 7, right? Calculating the value of a bond as well. I'm not going to bring that up again on this final, right? So I'm just helping you try to understand where to focus your time. So there could be a little bit of theory from this chapter. I'm not going to ask you to prepare the financial statements. We could have a little bit of theory or a little bit of calculation from this chapter, and I'm not going to ask you anything from chapter 7. The rest of the focus will be on items since after the midterm, right? Chapter 8, chapter 9 and 10, which was mostly chapter 9. And then chapter 12 and 13, we did chapter 12 in class. Chapter 13, we had good calculations in the video from a couple weeks ago. And then chapter 14, right, which was essentially what we did in class last week and the beginning of today's video. So I hope that helps prepare you for the final, where to focus. You're going to have a formula sheet for the formulas that you need, so you don't have to memorize those formulas, right? So hopefully that helps you out. Again, you're going to want to understand some of the theory because you might have a question on why something looks to be the way, right? Which one looks to be more volatile, right? Which project would you select over the other and why? So those are always good things to have a quick reminder of. Okay, so I'm going to leave you at that for this video. Once you've watched this, if you're practicing or studying and you have any questions this week before anything is due, feel free to let me know. Feel free to send me an email and I will get back to you. All the best with your studies and take care.